Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is our good friend Rafi Farber from the Endgame Investor. Rafi, it's great to see you again.
Good to see you guys. I'm always happy to be on Wall Street Silver.
Hey, Rafi, I know you have some thoughts on Twitter and Elon Musk. He's done the big old takeover of Twitter. What's your thought on this? In favor, against, indifferent?
Oh, I'm in favor of anything being brought of not anything of Twitter being brought private by Elon Musk. Definitely a positive. Not saying that I trust the guy or that I think he's the Messiah. Far from it. It's still a lot to worry about this kind of guy with this amount of money and power, but there's no reason to be disappointed about this. Certainly, we know that Twitter has suppressed a lot of information, and it's not even the information itself that's important to get out. It's the cultural signal that it sends that it's okay to do these things, and then it kind of encourages people that have no respect for liberty or no value of it at all to sort of like come out of their shells and abuse people.
Right.
What I remember from Elon Musk years ago, back when this whole medical tyranny started, was that he said that lockdowns caused him to lose faith in humanity, and I had the same exact feeling. Like if this is how humanity is going to react to this kind of event, then like really, I'm despairing about human nature and the human race itself. And the fact that he said that, and he allowed himself to be recorded saying that, say like maybe this guy's going to do something, or maybe he's annoyed enough to actually move. And really the downfall of government censorship and government power always comes from their own quarters. And Elon Musk has been a big recipient of government largesse for many years, and Twitter, sorry, not Twitter, but Tesla, it's made some money, but I think on net it's still a losing company. I haven't even checked the retained earnings from inception, but I'm pretty sure it's still negative. So
Yeah, I'm generally in favor. I think he's. I'm not real happy with the way things currently go with the censorship on Twitter. It seems they suspend accounts for really ridiculous reasons. There's probably some shadow banning for political ideology reasons. And if that's all Elon changes is fixing some of those major issues and makes it more of a, I don't expect it to become a total anything goes free speech platform, but I expect it to lean a bit more in favor of free speech than they're doing right now. But I know one of the things that you've been talking about recently in your writings is silver premiums, especially the premiums on junk silver. You had a chart you wanted to share with us on
yeah,
this?
hold on. This is when I look at premiums, I look at junk silver coins, meaning the 1964 before, with little to no numismatic value at all, because I don't want to incorporate in the price any crazy thing with the mint or the shutdown of this or that mint, or if there's like a fad going of some kind of like mintage or whatever the word is. These are the premiums of junk silver over the last 2 years. And let me widen the chart for a second here. Go to the long term. So this is as far back as gold charts or as goes to. So that's 2008. So see here at the end of the chart here, you see 2008, and then there's a spike into the financial crisis. There's another spike in 2013 where premiums go vertical. Another spike in late 2015, 2016 where premiums go vertical. Here you have the 2020 spike. I don't know what this like crazy up and down thing is. They must have changed the way they calculate it. But 2020 spike from 0% to like, it looks like 35% during that financial crisis. Basically, when you go back to these years, what you're seeing is not a movement in the physical silver price. What you're seeing is spot prices collapsing because traders are liquidating their futures positions, and physical silver prices aren't really moving much at all. So really, this is really stability. This is really the inverse of the movement of the spot price. But here, if you look back in 2011, 2012, right? In 2011, we all know what happened. Like silver went to about close to 50. You can see the spike over here. So if you look, here's the zero line, right? Moving across here with my little positive magnifying glass thing. So at certain points in 2011 and 2012, physical junk premiums went below zero, which means physical silver was selling at a discount to the spot price. And what does that tell you? That tells you that all the demand was in traders. It was some kind of game that was being played in the futures markets. Some position was being squeezed or something. We don't know exactly what, because there's all these big banks behind, and they don't, their dealings are shady. So in 2011, 2012, the demand for physical silver was negative. Right? People, you could get physical silver for cheaper than you could buy SLV shares. It was crazy. Yeah. But there was no really consciousness because there was no Wall Street silver. There was no silver movement. It was just like, what the hell is happening here? And it was just positions being liquidated in short squeezes, and we don't know what. In 2013, we had that really crazy sell-off in the precious metals bear market. In 2015, it was the end of the bear market, so premiums are spiking again. In 2020, silver went down to, I think, 1150, but physical prices stayed the same. But now, you see here, this trough in 2021, this little spike here, from here up to here, from like, it looks like 3% to like a 6%. That was Silversqueeze. Right, this line 6%, and then here up to like 15% or so. That was the first Silversqueeze. That was the first real movement, right? Because the spot price went up to $30 for a day, for just a day or two, but then it settled back down. It settled back down, and it's still around 23, 24, 25, going back before between there. But we see that premiums went from about 3% just on the eve of Silversqueeze to now it's at 20.31%. And where has the spot price gone? It's gone pretty much nowhere. It's gone up and down, but on net, it's stayed the same. So you would expect, if the price of silver were to stay the same, that premiums wouldn't go anywhere. They would stay at around 4 or 5% where they were before Silversqueeze. If Silversqueeze really died down, you'd see the premiums die down also.
Right.
But they're not. So the point is that Silversqueeze changed the consciousness. It changed the game, and it's still changing. People haven't given up on physical silver, and the price is still going up. So what I'm saying is that I'm the end game investor, so I focus on the end game. So I look at these signs for the end game. What is another sign of the end game with physical premiums? If physical premiums keep going up as the spot price keeps going up, then that will show you that the pressure isn't in the futures markets or the derivative markets or the SLV or the options or whatever. It's in the physical markets themselves, and we haven't seen that yet. We're starting to see it now. We've seen it for the past year and a half. Is it going to continue? That is the question, and we will see.
Yeah, that's very interesting. I've never seen this particular chart before, and we'll definitely be following up on this in the next few months as when we have you back on.
Can you explain negative equity on central banks' balance sheets and what it actually means?
Yeah, I can explain. If we go back. Explain it simply. Negative equity, in very simple terms, it means you're spending more than you make. If you're a household and you're spending more than your expenses are higher than your income, so you're at a loss and you're losing money. So the question is, what does it mean when a central bank loses money? And why is that important? If central banks just create money, why does it matter if they're in negative equity or positive equity? Isn't all just magic anyway? They just create money, and then it's just like magically it has value, and you say the spell on it, and they have their I don't know, their witch doctors in there, and who knows what's happening. But if you instead of, let's just take out the word central and just use the word bank. A bank thousands of years ago, to simplify it, would be an institution that would store your money. You would have money, you would have physical gold and silver because that was your money, and you were afraid of it being stolen. You'd have to invest in security for it, or you'd worried about maybe losing your hiding space or whatever it is. So you give it to the bank, and you'd pay them a certain fee, monthly, yearly, daily, whatever, and they'd store it for you, and they'd give you a receipt, and you'd spend the receipt instead of the gold and silver. Very simple. So their unit of liability was the receipt that they gave you. They could call it $1, they could call it a year, they could call it whatever the hell they wanted to call it. That was their liability, because once you give it back to them, they are liable to give you your money back, which is your gold or silver. So that is their liability. When the bank they realize that they have their ability to print all these receipts, they will print more of them than they have gold or silver, and they will buy stuff for themselves, which is what everybody does all the time. This is what humans do. They steal. There's no stopping it. The only thing that stops it is competition. So when that happens, more people redeem their receipts for more and more gold and silver. The bank runs out of money, and the rest of their liabilities are not backed by anything, so they fall to zero, and you have hyperinflation in those terms. But as that happens, you have the bank entering more and more negative equity, because they have more and more receipts and less gold and silver, so they have more expenses and they have income, same as any other person, any other individual. And then on the market, their paper receipts, rumors will start, and people will say, oh, I hear these receipts, you can't get gold and silver for them, and they're just paper. So then the prices of real goods and services will start to rise in the terms of those paper, and then you'll have more and more redemptions. So what we're seeing now is, if we scale it up, a couple of trillion times, is the same thing with central banks. They're in a situation of negative equity, where the assets that back their liabilities are losing value. They bought bonds at negative interest rates for, let's say, $1,000, just to put out a round number there. And now there are no negative nominal yielding bonds left, because interest rates have risen. So the value of the paper that they bought on their balance sheet is now down. So the central banks paid more for the paper backing their liabilities than the market value of those liabilities. So they are in negative equity. So that's when central banks enter negative equity, their banking clients, that's when they plow into real assets, and prices of things rise from there. It's just that instead of peasants saying, oh, they don't have gold or silver, I'm going to give them my receipts, it's banks like JP Morgan saying, oh, their bonds are going down in value, I'm going to give them the bonds, I'm going to take dollars, I'm going to buy natural gas or oil or gold or silver, whatever.
Right.
Or real estate is what they're. Yeah.
Real estate. Yeah.
Yeah. No, it's very interesting, and it's something to watch going forward for the rest of the year, especially with all the changes that the Fed's making. They want to aggressively sell off their own balance sheet. So that'll be really interesting with whether the Fed can do that. The Fed's been the biggest buyer of bonds, treasury bonds and mortgage bonds for the past couple of years. Having the biggest buyer turn into an aggressive seller, using their words, aggressive. How do you think that's going to play out? Can they do it? Is it all just talk?
Oh yeah, I think it'll be perfectly fine. Nothing's going to happen.
It's like watching paint dry, Rafi. It's just
yeah, like toxic paint. I don't know, like
lead paint, right?
It's not going to be pretty. But it's going to be very pretty for people who don't own the things that they're selling. So don't own anything that they're selling. Own the stuff that they don't own a lot of, which is gold and silver. They don't own any silver. They own some gold. They don't own any silver.
What about other metals? I mean, we always talk about the precious metals here, but it seems like all the other metals are really just going vertical lately. Whether it's nickel, zinc, all these, or platinum, all these metals coming out of Russia that are now off the market, or they're not necessarily sanctioned, but they're restricted just because it's tougher to get shipping out of Russia right now, because a lot of companies just won't go there. Insurance companies won't insure shipments coming out of Russia. What do you think about all these other metals that are responding the way we wish silver would?
Why is it happening in industrial metals first? I mean, typically you see prices rise in industrial commodities, because that's what companies need. I mean, when these miners or these companies are buying metals, they're not thinking in terms of sound money. They're not theorists. They don't exactly understand what is happening. So you have all these short positions on the LME or wherever it might be, that are being forced to be covered because suddenly the supply of this zinc stuff or the nickel is not being supplied. And unlike gold and silver, people actually need the nickel or the zinc to build whatever they're trying to build. So they'll take it off of you. They'll take it. So if you don't have it, where are they going to take it from? They're going to take it from the exchange itself. That's what they're going to raid the exchange, which it was never meant to do that. It was just meant to back a certain percentage of the contracts. But since you have these industrial players that are trying to actually get their hands on physical supply and they can't, they're going to raid the exchanges themselves. And then that's going to mess with the futures markets, and the shorts are going to get squeezed, and you're going to see all these crazy movements in nickel and zinc and whatever. But you're not going to have a single company that says, I need physical gold and silver right now because what? I need to what? What are you going to build with it? No.
Well, silver is an industrial metal. I agree with gold. Gold's not the same thing, but
it is, except silver, the silver futures is pretty much priced for silver as an industrial commodity, or else you'd see silver shortages and you'd have these companies saying, I don't have enough silver. You're not seeing that. But silver as silver and gold as a monetary commodity is only hoarded after or panicked after when the public understands that there's nowhere that the public aren't going to buy zinc or nickel because they don't need to build anything out of zinc or nickel. They need to preserve their value so they can buy food. And when you need to do that, you will buy the precious metals. But that's only when the public awakens, not when a certain company that needs zinc in order to build whatever they're building awakens.
Right.
Yeah. Hey, something you recently wrote about was the gold open interest. What are you watching there, and what should we all be paying attention to?
So this is in terms of gold open interest, this is what I'm looking at, right? So you see this bump here. This looks like November 2021, right? Gold rose from like 1750 to about maybe 1870 or so. It's like $120. And open interest over here in the second table here rose from looks like 520,000 to about 650,000. So like say 120, 130,000 contracts. And then there was a big sell-off at the end of November, right? And rapid sell-off, and then open interest collapsed from, let's say, 630,000 to 500,000. So you have like 130,000 contract sell-off. And that means that the bullion banks or whoever's short, not necessarily only them, they were able to cover a lot of contracts, right, and profit on their short positions. They closed their contracts and price settled down here. Here, we're not seeing that, right? We saw here gold hit 2,000 at the end of the chart here. And then since then, it's fallen by about the same amount as it fell from here in 2021. 130,000 contracts is here. It's fallen the same dollar amount or around the same. And look at the open interest. It hasn't really moved much at all, like maybe 20,000 contracts at most. So what this is telling you is that whoever's short has not been able to cover. The longs are sticking with their longs, and they're holding their losses. And the bullion banks are unable to cover. So if there's no real decline in open interest here, then in the next rally, we might see all-time record amounts of short contracts in the bullion banks, because in order to when there's more buyers, there has to be short sellers, because who are they going to buy from?
Right. Yeah, no real time frame for this, but you're just saying the technical setup or the fundamental setup here would favor a rally to above 2080, the all-time high.
Yeah, I would say so.
Yeah.
Just speaking in terms of open interest, but that, sometimes it doesn't work out. But looking at all the other things that are going on in the world,
there's no reason for gold to really go down at this point. Is what it's a higher percentage play to go up at this point.
Yes.
Yes.
And silver as well.
Yeah. Well, on that note, Rafi, thank you very much for joining us. We really love getting your insight. Your website is the Endgame Investor. I'll have the link in the description.
Yeah, I'll give it to you in the description. Sure.
Sounds good. Hey, we'll talk to you again in a few months.
Thanks, Rafi.
Okay, great.